Hi everyone and welcome to Lean Finance. My name is Sven and this channel is about finance, investing and money. The goal is to share knowledge and my experience with you and to show you that personal finances don't need to be complicated. In this video, I want to introduce you to the investment strategy of passive investing and why this strategy could be perfect for a successful performance at the stock market. So let's go with this next video. A great way to explain passive investing as an investment strategy is comparing it to its counterpart, the active investing. As an active investor, you analyze and select individual stocks, hoping that these stocks will outperform the returns of the global stock market. Active means that you speculate and actively trade with your investment because you think that you know which companies and industries will perform better at the stock market than others. If you want to be successful as an active investor, you need to research and analyze stocks, financial data, ratios, and the stock market news. Besides knowing which stocks to buy, you also need to decide when to buy and sell these stocks, which is called market timing. You might already have noticed that an active approach seems to be quite complex and time-consuming. Compared to that, passive investing is an investment strategy based on an index investing and buy and hold strategy. The passive investor trusts that the global stock markets will develop positively in the long term and does not speculate with investments into single companies or industries. Instead of actively picking individual stocks and building your own portfolio, you buy the entire global stock market, maximizing the diversification of your investments. Usually this is done with an ETF, which tracks the performance of a global index, like for example the MSCI World Index. In my next video, I will explain to you what exactly an ETF is. In addition, you follow a buy and hold strategy with your portfolio, meaning that you buy and then hold your stocks and ETFs over the long term. In short-term price fluctuations or crashes of the market, a passive investor is not led by emotions leading to panic sells, because he believes that the crash will be compensated in the long run. Also, he doesn't chase trends or some supposed insider tips for the new great investment opportunity. As a consequence, a passive investor only checks the portfolio rarely, because the goal is to let your investments work for you in the long term. Let's now have a look at the benefits of a passive investing strategy. First benefit, it is easy. Compared to an active investor, you don't have to deal with company ratios and balance sheets or read stock market news. You fully rely on an index fund that is already compiled following the global stock market. Therefore, passive investing is the perfect approach for people who are not or do not want to become stock market experts, but who want to profit from stock market developments and generate returns on their savings. In addition, there's no minimum budget, so that you can set up an ETF savings plan for only 25 euros per month. Second point, it is less time consuming. Passive investing takes a lot less time because the time for research and analysis is limited. Also, market timing does not play a role compared to active investing. This saves you the stress of having to catch the right moment for buying or selling your stocks. After all, your strategy is designed for the long term, so you don't have to worry if the prices of your investments go down for a few weeks. Usually you have to spend some time at the beginning to set up your passive investing approach. But afterwards, you might just check your portfolio 3 to 4 times a year. Third benefit, it is cheap. In addition to saving time, you also save a lot of costs as a passive investor. In most cases, it is much cheaper to invest in an ETF than to buy individual shares, active investment funds, or other investment products. All these products have significantly higher transaction, trading, and management fees. These fees automatically reduce the total return on your investments, so that ETFs have the advantage here. Fourth point, it is less risky. With an ETF, you automatically invest in a large number of individual stocks, so you're automatically quite diversified. You don't invest in just one or a few companies, but in all companies included in an index, like the MSCI World Index with 1,600 companies. In one of my last videos, I already explained how diversification lowers the risk at the stock market by eliminating the company-specific risk, just leaving the market risk for your investments. Last point, it works. As a passive investor in the global stock market, you always get the market return on your investments. The average return at the global stock market for a long-term investment of 15 years was 7.9%, as already shown in one of my previous videos. In addition, a lot of studies showed that active investing is usually achieving a lower return on investments than passive investing in the long run. There might be time periods where investors can outperform the global stock markets by investing in single companies, but they cannot hold this performance constantly over several years. So all these benefits make me personally a big supporter of the passive approach, because of its simplicity and freedom of emotions. If you, of course, prefer the active approach because you are a strong believer of the strategy or because it is fun and a hobby for you, then that is also perfectly fine. But you should be aware that it's usually more time-consuming and less profitable in the long run. At the end, everybody has to do his own research and decide which investment strategy is the best for him or her at the stock market. Passive investing is an investment strategy based on index investing paired with a buy and hold approach. It is easy, less time-consuming, cheap, less risky, and it works. The core of the strategy is to simply follow the long-term development of the global stock markets with investments in global ETFs. I hope this video helped you to understand passive investing and its benefits better. Feel free to subscribe to stay on board for the next video and to leave a like to support this channel. I am looking forward to getting your feedback in the comments below and preparing the next video for you. So see you soon and have a great day.